Good morning, everybody, and thank you very much for joining us on this webinar, where we'll be looking at issues around pension freedoms. In particular, we're going to take an individual's point of view and ask how important pension freedoms are. To what extent do individuals approaching retirement have significant sums in defined contribution pension pots that they'll have to make decisions over how quickly and to draw down throughout their retirement? We'll be asking how have individuals who've experienced pension freedoms in the last few years used those freedoms, and how do those approaching retirement expect to use their pension pots once they get to that point? I'm Carl Emerson. I'm Deputy Director of the IFS, and I'm chairing this event. We're going to have two IFS presentations, first from Jonathan, who leads our work at IFS, and then from Heidi. And after that, I'm very pleased that we're going to have two external views on our work. We're going to have Nigel Peaple, who's Director of Policy at the PLSA, and Nick Flynn, who's Director of Retirement Income at Canada Life, both giving their perspectives on our research and what the implications are for individuals and also for policy. If you'd like to ask questions, please do. You'll find in the YouTube link details of how to do that. It's via Slido. Do enter your questions there and do vote for the questions that you think are most interesting. At the end of the formal part of the proceedings, I'll be drawing on those questions, and in particular from those that are voted towards the top, and putting them to our panel. Before I hand over to Jonathan, I'd just like to thank those who've made this research possible. That includes the Economic and Social Research Council, for whom everything at IFS is made possible. But on this particular piece of research, it's also the IFS Retirement Savings Consortium, a grouping of organisations who've worked with us over the last 2 years, contributed to the work both intellectually and financially to make it possible. And that group of individuals includes Age UK, the Association of British Insurers, the ACA, Canada Life, Interactive Investor, the Investment Association, the Money and Pension Service, the PLSA, as well as the Economic and Social Research Council. So that's all from me. I'll hand over to Jonathan. You'll then hear from each of our speakers in turn before we have the Q&A session. Thank you very much.
Thank you, Carl, and good morning, everyone. Thanks for joining us. I'll start. I will start our presentations by thinking about how important defined contribution pension wealth is for people approaching retirement. Now, most of this will probably be known by a lot of the audience, but to make sure that we are all up to speed and on the same page, just want to remind us of where we are. So there's been a decline in traditional defined benefit pensions and a growth, particularly since automatic enrolment, of defined contribution pension arrangements. Now, prior to 2015, buying an annuity or a guaranteed income for life was almost compulsory for those with DC pensions. But so-called pension freedoms in 2015 ended that obligation. People are now free to choose how to draw upon their defined contribution pension wealth in retirement. And the most obvious thing that happened there was that the annuities or the income for life, the purchases of those products subsequently collapsed. Now, given this background, there have been underlying concerns about the complexity of this decision on how to draw upon defined contribution pension wealth and whether people are making appropriate choices. In that context, we think there are some key questions that we set out to answer today. So really, how important are these choices presented by pension freedoms for people? And the answer to that is going to be dependent upon answers to a whole load of other questions, such as how important and how prevalent are defined contribution pension pots? How much wealth do people have in other forms of pensions or in other assets? And in terms of that other wealth, how annuitized is it? That is, to what extent does that other wealth already provide a stream of income or consumption that people can use through to the end of their life, guaranteed through to the end of their life? So the data that we are drawing upon in this research is from the Wealth and Assets Survey, which is a longitudinal study of people going back to 2006-ish, and it goes through to just before the pandemic. There's a substantial sample of people, and it has detailed data on all wealth holdings. Now, importantly, that includes both private pensions on the defined benefit and the defined contribution side, financial savings, and housing wealth that people have. And it's not only for individuals, but for all members of the household. That's going to be really important if you are somebody with a defined contribution pension, potentially small, but you're married to a doctor, for example, with a large defined benefit pension plan. We also know broader data on individuals' background, economic circumstances, and what they expect to be doing in their life. So using those data, how can we start answering the questions I put up earlier? Well, first of all, if we look at people who are approaching retirement, that they're in their 50s, we can see that most people have some private pension wealth. And if you add together the green and the kind of bluish bars here, you can see that about half of people have defined contribution pension wealth in their 50s, and that about a third of people in their 50s have only defined contribution wealth, but no defined benefit pension wealth. Defined contribution pension wealth is also slightly more prevalent for men than it is for women. That's going to in part reflect different employment rates and employment rates that are different in public and private sector. Of course, defined benefit pensions being still prevalent in the public sector. Now, this means that significant numbers, but clearly not everybody in their 50s has DC pension wealth, over which they will need to make financial decisions when they come towards retirement. How might that change, though, in the future? So if we now look at the proportion of individuals with DC pension wealth by generation, by years of birth, we can show this in this graph here. So if I bring up these first two lines, this shows people born in the late 50s and the mid 60s. And you can see there that that's reaching that 50% line for those born in the mid 60s. But we think that that is going to increase over time. You can see not only are these lines upward sloping, but if I now look at younger generations, you can see that each generation, successive generation, is above where its predecessor was at the same age. What's happening here is that the decline in DB pension schemes and the rise of DC pension schemes through, in particular, automatic enrollment, means that we think that as people age, it's going to lead to the younger generations approaching retirement with more DC pension wealth, both in terms of number of people and in terms of the pounds amounts that they have. So that means that these decisions, however consequential they are now, and we'll go on to discuss that, are likely to become more consequential over time. So the importance of the decision, therefore, is also dependent on what other wealth people have, and that is shown here. So this looks at individuals who have DC pensions in their 50s and how much of their wealth is made up by different types of wealth. We include in that the promise of a state pension to people, that is a promise of an income through retirement until death. We include in that, of course, a main property, because you get to live in that. And most people, of course, who own property at these ages, or at least in retirement, will not be paying any mortgage. We include other property wealth, second homes, financial wealth, and there in blue you can see DC pension wealth makes up about 15% of wealth of those who have DC pensions in their 50s. And that's actually roughly similar to the amount of wealth that these people have on average in DB pensions. So that means that this wealth, while it's not negligible, it does not make up a very a really substantial fraction of wealth on average at the moment. But how that is going to be distributed across individuals may be very different, and that's what I'm going to look at next. So this is a slightly complicated chart, so I will talk it through quite carefully. But basically what we do is we look at the wealth that people have and then convert it into a stream of income that we expect for people to have at age 66, current state pension age. We then line people up from the left, from people with the lowest retirement incomes on the left to the top retirement incomes on the right, and see how they are made up. So first, just as a fairly simple assumption, we actually just assume that everybody will get the full state pension entitlement, new state pension entitlement. That's not going to be completely right, but for our purposes is probably close enough to correct. On top of that, we then want to add the fact that some people have DB pensions. That comes in the yellow, and you can see that's really clustered towards the top of the retirement income distribution, and people who are already receiving pensions. Now, it's also important to put in housing wealth here. There's a broad amount of housing wealth, again clustered, of course, towards the top of the distribution. But that's important because if people don't have that housing wealth, of course, then they're going to need to cover rent with their retirement income. That's why it's very important to include it. And finally, I'm going to put in here the defined contribution income. That's just assuming that people get a inflation indexed annuity to convert it into an income. So what does this mean then for the importance of DC pension incomes? Well, firstly, even at the median, you can see that this implies somebody with £4,000 of income from a DC pension, which is not a trivial amount, but that goes up massively to, in the top 2%, somebody having equivalent of £50,000 per year in DC pension income. So very unequally distributed, of course, but even at the median, £4,000 per year is, of course, not to be sniffed at. Looking at it like this, though, I think it makes it quite hard to see for lower income people the importance of DC wealth. So instead of looking at how much this is in pounds terms, I'm going to, for each bar here, look at the composition of retirement income. So these has the same colors, with the green being state pension through to blue being income from DC pension wealth. And now you can start to see how important this is. You know, towards the bottom of the retirement income distribution, some people have very, very small amounts of DC pension wealth, and therefore it's almost negligible. Roughly the bottom third of the income distribution, though, has around 10% of its retirement income from DC wealth, rising to around 20% in that kind of middle to upper middle group, and rising to almost 40% at the very top. Now, I think that this does help us think about which people we're likely to be most concerned about the decisions regarding the drawing of DC pension wealth. And I think that it points towards that the middle to the upper middle part of the retirement income distribution is where we want to be more concerned. You know, more than 10, maybe up to 20, 25% of people's wealth of retirement income coming in effect from DC pensions. That makes it a really consequential decision. We're probably not quite so concerned about the very top of the retirement income distribution, if only because, as I showed earlier, the very large amounts of other income that these people have. So middle to upper middle being an area of the income distribution that we probably want to be wary of regarding these decisions. So, quick summary from me before I hand over to Heidi. DC pension pots are becoming increasingly prevalent among successive generations of workers, in large part due to automatic enrollment. The large majority of people, they represent a fairly small proportion of wealth compared to much larger fractions in annuitized state pension housing and DB pensions. Therefore, lots of people do have significant insurance against longevity risk. However, I think that the group of concern is most likely to be people in the middle to upper middle of the income distribution. That's all from me. I'm going to hand over to Heidi now, who will do the second presentation of this morning.
Thank you very much, Jonathan. So in that first section, Jonathan set the scene for us for how important pension freedoms are by looking at the importance of DC pots in people's overall wealth portfolios. But of course, what these pension freedoms mean for people is that they're now faced with this new financial decision they need to make at older ages. So how am I actually going to access this DC pension pot I have? So that's what I'm going to be looking at today. So we're going to be looking at how are people planning to access their DC pension pots, and then also focusing on the subgroup of people who have already accessed their DC pots by taking them out in full, and trying to look at who are those people and what can we say about their characteristics. So in this first section, I'll be looking at how are people planning to access their DC pension wealth. So in the latest round of the Wealth and Asset Survey, people who have these unaccessed DC pension pots are asked, how are you planning to access that pot, or the rest of it if you've already accessed some of it? And this question is asked for everyone who's aged 50 or over. And people can choose all the options that apply from this list here. So they can say, I don't know what I'm planning to do. They can say, I'm planning to buy an annuity offered by my own pension provider. They can also say that they're planning to buy an annuity, but planning to shop around in the open market. People can also choose, I'm going to go into flexi access drawdown, take cash in chunks from the pension pot as I need, or leave the rest of the pot untouched apart from any tax-free lump sum. And if we're then looking at this sample of people who are asked these questions, so we're focusing on those who are in their 50s and early 60s. So this sample here, they're mostly men, so just over half are men. Vast majority of these people are still in paid work, and about 80% are in their 50s. Most people have just the one DC scheme or one scheme where they answer these questions for, and the median DC wealth among this sample is about £34,000. So what we've done here first is just record the prevalence of these responses across all the respondents. And again, people can give more than one answer here, so these don't actually add up. These add up to a bit more than 100, but most people give just one answer. So what do people say when they're asked, what are you planning to do with your DC pension pot? Well, we find that more than 4 in 10 answer, I don't know. And I think this is quite remarkable, given that 60% of the sample that we're looking at here are aged 55 or over. So if they today decided that they wanted to access their DC pension pot, they could go to their provider and get access pretty much immediately. But about 40% of people saying, I don't actually know what I'm planning to do. We also see that about 20% are planning to buy an annuity, although somewhat maybe worryingly, majority of these people are planning to just buy an annuity with their own provider, even though we know that people tend to get better value for money if they shop around in the open market. We also see 14% of people planning to go into drawdown, about 1 in 5 planning to take cash in chunks as needed, and then about 8% planning to leave their pot untouched. Now we can also look at whether there are differences in the prevalence of each of these answers between different groups of people. And here I'm splitting the sample into 3 based on people's individual wealth. And we can see that there are big differences in the prevalence of these answers between wealth groups. In particular, people in the lowest third in terms of their wealth are much more likely to say that they don't know what they're planning to do with their DC pension pot. So we see that about 60% of that lowest wealth group saying they don't know what they're planning to do. But even when we're looking at the top wealth group here, we still see that almost a third of them are saying that they don't have a plan for how to access this DC pension pot. We also see some differences in these other responses. In particular, those in the higher wealth groups are much more likely to say that they're planning to access their DC pension by going into flexible drawdown. And that is actually true even if we exclude these don't know bars here. Now, while it's interesting to look at these differences in responses between different wealth groups to get a better understanding of which of these characteristics or which characteristics are associated with different plans for DC pension pots, we turn to multivariate analysis. So in the reports that's out today, we show regression results to see which associations between demographic characteristics, individual and family characteristics, and these answers remain even after controlling for a wide array of other characteristics at the same time. And in particular, in these regressions, we're controlling for many individuals and family characteristics such as age, sex, employment status, marital status, education, housing tenure, economic variables such as wealth, income, and so on. And also there's questions around financial literacy and whether someone's used a financial advisor in the last 12 months. And I'll just quickly summarize some of the key findings from the regressions that we've run. So we find that even after controlling for all of these characteristics that I listed on the previous slides, we still see significant differences in the prevalence of these responses by wealth. So in particular, those with more wealth are still more likely to prefer this flexible access and less likely to say, I don't know what I'm planning to do with my pension pot, than those in the bottom of the wealth distribution. And that's even after we control for things like income, education, and so on. We also find that those who are still in employment are much more likely to say that they don't know what they're planning to do with their DC pension pot. And this is maybe consistent with some people only starting to make solid plans on how to access their pensions once they leave paid work. We also find that those who've used a financial advisor in the last 12 months are much less likely to respond that they don't know how they're planning to access their DC pension pot. And they're more likely to say that they're planning to access their pot through flexible drawdown than those who did not use a financial advisor. So this suggests that maybe using a financial advisor can bring clarity to people's pension plans, although we can't claim in any way that we've identified sort of a causal relationship. It could be that those who are using financial advisors were more likely to have a plan for their retirement finances anyway. And finally, the Wealth and Asset Survey, as I mentioned, asks questions about people's financial literacy. These are questions that try to get to whether people understand inflation, whether people can read a bank statement, and so on. And we find that answering, there's 3 questions in particular that we look at, and we find that answering all of these 3 questions correctly is associated with being more likely to plan to buy an annuity. So that's another interesting finding here. So that's what we find when we're looking at what people are planning to do with their DC pension pots. And in this final section, I'm going to be focusing on the subsample of people who have fully withdrawn their DC pension pot in order to understand a little bit more about their overall circumstances. And the motivation for this section really was this picture from the FCA, which many of you might be a bit familiar with. So this shows how DC pension pots were accessed in 2021-22. And you can see the vast majority of these DC pension pots, especially the smaller ones, those worth less than £10,000 and those worth less than £30,000, were withdrawn fully when they were first accessed. But of course, this is pot level administrative data. So what this picture does not tell us is it doesn't give us any information on other wealth that people may be holding, or it doesn't tell us anything about their other household circumstances. So things like, do they own their home, or do they live with a spouse? So what we've done, what we can use the Wealth and Asset Survey for is to look at how do these amounts that people are drawing from their DC pension pots in full compared to the overall resources available to people. And then what are the characteristics of these people who've taken out their DC pension pots in full? So first, I'm going to start by looking at the distribution of the amounts that are drawn. So here, take the sample of people who say that they've fully drawn a DC pot in the last 2 years, and then look at the withdrawals they've made from their DC pension pots in that period. So we can see that the median withdrawal was worth about 22,600, and 75% of these withdrawals were worth less than 47,000. But what's really quite striking is that on average, these full pension, even though these people are taking DC pension pots out in full, these amounts only represent a relatively small proportion of people's overall resources. So the median pension withdrawn fully was worth just 3.1% of the family's total resources or total wealth. And it's only for the sort of top 10th of households where the value of the full withdrawal was more than 16% of their total resources. Now, in order to try and answer the question of a little bit more about who are these people in the FCA data who are taking out their pension pots in full, and sort of how worried should we be about them, about people taking out DC pots in full, we can compare these households who have done that in the last 2 years to households who have DC wealth but haven't fully withdrawn their pension pots. Now, so that's what I'm doing here. So first of all, if we're looking at the prevalence of these households having DB pensions in the households, you can see that the people or the households who've taken out DC pots in full are more likely to have a DB pension in the household. And what these bold numbers here mean is that these numbers are statistically significantly different from each other. We can also see that those, especially those in their 60s who've taken out a DC pension pot in full, are more likely to own their home outright, less likely to be renting. And also people who've taken, or households that have taken out their DC pots in full are more likely to have live in a couple. So why have I chosen these characteristics to look at? Well, this sort of suggests that it's not only that the lump sum drawdowns or the drawdowns that people have taken from their DC pots in full are quite small in proportion of to their overall wealth, but these households also seem to have quite a lot of annuitized sources of wealth and other sources of resources and support, such as having a spouse. So this is somewhat reassuring in the sense that we might worry less about them running out of money or having other adverse financial outcomes in retirement, even though they are taking out these DC pension pots in full. And another interesting finding that we found relates to giving gifts. So the Wealth and Asset Survey asks, have you in the last 2 years given a gift or a loan worth more than £500 to family or friends? And we can see that, among especially those in their 50s who've taken out a DC pot in full, they're almost twice as likely to have given a gift or loan to a family member or friend in the last 2 years compared to those who didn't take a DC pot in full. Previous IFS research has shown that most of these gifts are given to children, so this suggests that maybe some people are using their DC pension pots to help family members. So what I've shown so far is that there are some of these reassuring patterns among those who have withdrawn a DC pot in full, in the sense that they seem to have a lot of other resources, or many of them seem to have a lot of resources to fall back on as well. But are there people we should worry about more? And we can think about this through this quite a simple grid. So what this grid does is it just illustrates the fact that when we're thinking about these the amounts that people are withdrawing from their DC pots, we should think both about the pound amounts, but also what that represents as a proportion of people's overall wealth. And based on those two factors, we can then think of people in these different boxes. And so for those people for whom these amounts are small, either in pound terms or as a proportion of their overall wealth, or both, we may not need to worry so much about them. But where we really worry more, or might worry more, about people potentially making suboptimal decisions, which might lead to adverse outcomes for decades in retirement, where those risks seem the greatest, are those who take out a large DC pot out in full, and for whom that large pound amount also represents a large proportion of their overall wealth. So that's where the risks really are the biggest. Now, it's a little bit arbitrary to choose what these limits should be, but as an indicative exercise, we've chosen £20,000 and 10% of overall wealth here as the kind of thresholds. And if we're then looking at where do our sample fall in this grid, we can see that, again, reassuringly, majority of people are in these kind of less worrying cells, less worrying groups. But we do find that about 16% of our sample are in this group that we might be more worried about. They're taking out more than £20,000 out of their DC pension pots. And when comparing that to their overall household wealth, it's worth more than 10% of that portfolio. So, this is not that this is still a minority, but it is an important minority. It's not a trivial number of people. And as DC wealth in the future is more likely to make up more of people's overall resources, the risk of people ending up in this group will be growing. So I will just now finish off by with a bit of a summary and conclusion. So what I've shown you today is that nearly half of people in their 50s and 60s don't know how they plan to access their DC pension. And this is even more likely among those with low levels of wealth, even after we control for other characteristics. We then also saw that even these DC pots that are drawn out in full, on average, actually make up a pretty small fraction of people's overall resources. But there is a minority of individuals and households that are taking out large sums of money from their DC pots without a buffer of other resources. And as the importance of DC pots as a proportion of wealth is increasing over time, we do think that future generations will be at more risk. So finally, some policy implications. There's a lot that we could talk about here, but I'll just mention a couple. So large lump sum drawdowns aren't automatically a cause of concern for policymakers, as we've shown today. At the moment, at least, the majority of households that are taking out large amounts of money from their DC pension pots have other resources available to them and other sources of wealth also. But the key question then becomes, how can policymakers and industry identify those people who are in the most worrying at-risk group to target help and advice to those people? And as I've mentioned, as the importance of these DC pension pots increases, as those DC pots make up more of people's resources in the future, this is becoming a more and more important question. And that's why it's important that we're thinking about this now and getting it right now. So that's it for me, and in terms of our presentations. And I will now pass on to Nigel Peaple, and we'll stop sharing my slides. Thanks very much.
Hi, hello. Right, thanks very much, IFS, for inviting me to offer some comments. PLSA was very pleased to be one of the funders of this important work. There's been some great attitudinal research so far, but this research has gone further, looking at what actual decisions are made, and very importantly, taking into account the financial circumstances of the individual. So it's very helpful. Just before I offer a few comments on the research and the policy implications, I'll just explain why the PLSA is interested in this piece of work. Two things. One, you may be aware we've long argued that the rate of automatic enrolment contributions needs to rise from its current 8% up to about 12% over the next decade. In no way doing this anytime soon while the cost of living crisis is upon us, but there really does need to be a bit more money going to pensions, split 50-50 between the employer and the employee. And also, our members have for some years argued that we need different solutions in the retirement space, and ideally a sort of blended product that gives people a cash amount, an amount that can be invested and drawn gradually, and importantly, some kind of later life annuity, all baked into a single product. And we call that the guided retirement income choices. So we were very interested to understand what's happening right now in terms of decumulation, and to see also whether our own policies are kind of appropriate. So in terms of points of interest, just quickly, yep, still interesting, obviously, I suppose, to see that DC is still not the predominant form of saving, form of retirement income. I suppose I was even a little bit surprised just to see how important it continues to be, actually. DC pensions, they're still pretty small. People won't be buying a new Lamborghini, but maybe a very old and backed up one might just be manageable. But despite these quite small amounts of DC pension saving and the way that households are still not relying on them that much, I still think they're very important. So if you think about people lower incomes, all the projections are that they, whilst they'll benefit from, quite a good state pension now, it's getting better, it's still not up to the Retirement Living Standards minimum level, which is also the Joseph Rowntree Foundation minimum income standard. So there between the state pension and that minimum decent level of living. So even quite a small DC pension fill that gap. And then for people, above median earnings, we know that using the old Pensions Commission target replacement rates, what's clear is that they are generally under saving. So again, the decisions they make, even when they're quite small DC pots, are important. A couple of other observations on the research. I thought a little bit the confusion about planning for retirement is quite interesting. 43% said they didn't know. Obviously, some of those people will just be younger. It's a 50 to 64 age bracket IFS look at. Some of them are far away, but, still, you might hope that people with that much experience of living might have a bit of an idea about what's coming next. And I suspect there's a lot to do with the sheer complexity of the post-freedoms environment. I also thought it was very interesting that people who've scored highly on financial literacy chose an annuity, which is reassuring, because we're always seeing how other bits of research show what people want in retirement, is a steady income and an income for life, which sounds a lot like an annuity. But it's also interesting to see that those who take in financial advice, we're choosing for drawdown. I'm not saying that's a bad choice at all. And again, from this data, where people actually have DB pensions as well, that's probably, a very good decision. But I thought that was rather interesting. And then finally, in terms of policy implications, thinking about the two presentations we've just seen, I continue to think the state pension has a really vital role, and therefore it makes good sense, despite it being expensive, that the current government and the opposition are both saying they probably have a commitment to the triple lock. I think this research suggests that there are no immediate problems with what's going on regarding decumulation because so many people have some DB entitlement. Might be interesting to understand, and I expect IFS have done this, to drill down into those with only DC and see a bit more what's going on. But what we do know, of course, as the research showed, is that people will be increasingly relying on DC. So I think the policy implication of that is that we need to act now and just for a change, close the stable door before the horse has bolted. And then my final policy implication from all this is that, yes, it's all very complex, isn't it really? And therefore, I think we do need to try and find a way to simplify it. And while advice clearly has a great role to play, difficult to make that affordable for everyone. So there's a need to simplify things, simpler products, and then you can have less reliance on the advice element and more on general guidance. Obviously, all this was backward looking. It's the nature of the work. But at some point, good news for IFS, I think we'll need to repeat this so that we can see the impact of COVID, see the impact of cost of living crisis, and maybe even, as I think some other speakers might comment on, see the impact of improving annuity rates. And they were my comments. I hope they're helpful.
Thank you, Nigel. My name is Nick Flynn from Canada Life. We've been involved because we have a vested interest in the retirement market. We're a huge annuity provider. We have enhanced annuities, lifestyle annuities, fixed term annuities. We're big in the drawdown space, and we have a hybrid offering as well, so annuity and drawdown. But what I hope to be able to offer is some thoughts on where we are now. Obviously, the research is looking to the past, and it's picked up some really key things. And I think the most important one is knowledge. I think people's knowledge, experience, and thoughts of DC retirement is limited. It's been a relatively modest part of their income, modest part of their wealth, but I think that's growing quite quickly. And I think we've found we're in a situation where we've got a real pent-up demand for solutions. People put a lot of decisions on hold over COVID. Why wouldn't you? They didn't spend a great deal of money because they couldn't. But now they need to spend money. They need to pay the bills. The cost of living crisis is significant, and it's affecting everybody, but it's particularly affecting those that are in their later life who are trying to maybe support other members of their family as well. So we're seeing people accessing their pensions in numerous ways. In fact, We are super busy, and we've recruited additional staff and better systems to try and increase our capacity. In fact, May just gone was our biggest month since pension freedoms in our annuity area. Give you an idea of how much it's recovered, and a lot of that's due to the attractiveness of the annuity rates. But I think people are changing. The economic reasons I touched on, falling employment rates for those in later years, helping the family members, the limited market growth in equity markets, meaning people are looking to do something different, maybe looking for some security. The fact that we're pushing insurers are pushing people to pension-wise appointments, go and speak to pension-wise. We need to make sure that everyone has done that before we can proceed with anything else. Consumer duty is coming in the summer. That's going to start pushing advisors, insurers to start behaving slightly differently. And the open market option, both promotion and the fact that people are so keen to get extra funds, get the maximum amount from their pensions, is starting to happen. The ABI came out with some stats talking about how the annuity market has grown, but the annuity market on the open market has grown disproportionately, in fact, 60% in Q1. So I think this seasonal surge in demand will continue. There's new market entrants joining, in fact, one just this week. It's the first time we've seen new entrants in the annuity market since pension freedoms. And I don't see this changing. I think the demand for advice will grow. Most of the insurers will either operate via brokers, IFAs, financial advisors, wealth managers, and often direct to consumers as well. So I think this area will just fascinate us further and further as DC becomes more important. And I look forward to an update in the future. Pass it back to Carl, please.
Thank you very much, Nick. Thank you also, Jonathan, Heidi, and Nigel. So when I go to the questions session, please do keep posting your questions on Slido. To start with, there's a set of questions which I think are really around kind of measurement. They're about what the numbers we've produced in our report. So Heidi, I'd like to turn to you and just sort of perhaps go through a little bit more detail on some of that. People are asking about, well, how are we comparing the value of a DC pot to a DB pot? Well, how do we get the values in the same terms, as it were? Why are we using indexed annuities, given that bluntly no one buys them when we do that? What is included? What about people with lots of buy-to-lets or bonds or other forms of wealth that particularly maybe the wealthiest might have quite a bit of? And I guess maybe a decision that people might see as perhaps controversial. We've made the decision to include the value of one's own home if it's owned outright. Why have we done that? What are the arguments for that, and why do we think that's appropriate? There's quite a lot to unbundle there, but I think they're all around kind of the measurement of retirement income.
Yeah, no, they're all very, very good questions. So I might start with the housing one. So yeah, it's of course it is probably a more illiquid form of wealth, absolutely. But by including the housing wealth, we're sort of taking into account the fact that people get a benefit from it throughout retirement. So they kind of get a stream of housing, they get a stream of consumption. Now, the other way we could have done this is to try and reflect housing costs for everyone. So then those with, especially when we're looking at people's incomes, we could have looked at after housing cost incomes. In which case those who own their homes would have either no or very low housing costs. And then those who are renters, especially in the private sectors, would have much higher housing costs. So the kind of picture would still look quite similar, even if we did it that other way. But I think that's why we think that it's important to include housing wealth in order to make sure that we're reflecting that fact that people do get benefit from it, and would otherwise have to be in the rental market. In terms of other wealth, so we have in the wealth and asset survey, it really does try and capture all of people's wealth. Of course, it is self-reported, so to the extent that people don't report their trusts or things, we won't capture. But things like other property is included in that analysis that we're doing, and we do of course see that those at the higher parts of the income distribution or wealth distribution have more of those available. In terms of other questions, why did we use the index-linked annuity? Well, that's again a choice that we made. I think, first of all, it's the index-linked annuity. Potentially, yes, we know that very few people are buying them. We're now seeing a bit of a pickup, given that the annuity rates are improving. But it really it is probably the one that we think that people should be thinking about when they're entering into retirement, so that that their standards of living keep up with inflation. But also that sort of provides, when we convert people's DC pension wealth to an annuity based on that annuity rate that's inflation linked, that kind of gives us the minimum amount that they can get from an annuity. So that's kind of another way to think about it. I think that I've probably answered most of the questions that you laid out there, but please feel free to, if anyone has any more clarification questions on Slido, feel free to get in touch.
And I think on the use of an indexed annuity, it's partly about trying to compare a DC pension to a DB pension.
Oh, yes.
And DB pensions are typically have some inflation uprating, so it seemed appropriate to have the same kind of uprating as close as we could get in a DC arrangement. So we're comparing like for like. We didn't want to compare a nominal income stream with a real income stream.
Yeah.
That would overplay the importance of DC pensions in the first year of retirement, which we thought was pretty important.
And the same goes for state pension, of course.
Yeah, absolutely. And of course, some people might validly think that they want to buy an annuity that gives them more of their income earlier on. But we did do some research as an earlier part of this consortium that cautioned against people having that view that, oh, it's obvious my spending needs will be lower towards the end of my retirement. I think as far as we could tell, it looked like on average a flat profile wasn't, or possibly even slightly rising for those on the top half of the income distribution, wasn't so inappropriate. And it certainly wasn't obvious from data that people's spending patterns really did suggest that they were spending lots of money early in their retirement and that was dropping away as they reached their sort of late 70s. Question I'm going to first of all pass to Jonathan. There's someone being slightly critical our data are old. I guess doing research with data means we always have to wait for those data to be collected and available before we can crunch them. But A, how old are they? And B, I guess, what might have changed, or how might the future look different? And I guess I'm thinking that the two big changes we might see are, firstly, there's been a lot of changes on interest rates, might change the attractiveness of annuities. And I guess then there's a slightly longer run question about, we know that DC is gaining ground and that DB is fading away, at least in the private sector. How quickly might we expect that to happen? Is that something going to be very fast, very gradual? Any thoughts on that, Jonathan? And I'll then hand to Nigel and Nick on that as well.
Yeah, so the latest data we have on this is from 2018 up to 2020. Specifically, that literally finishes just before the pandemic, based on when the government's Office for National Statistics stopped surveying people. So clearly the world is massively different since then. We didn't know nobody really in January 2020 really thought what would happen in the rest of 2020. But people have accumulated a lot of savings during COVID. We've had a high inflation since, increasing interest rates. Clearly that's feeding through into annuity rates, and of course mortgage rates for affecting younger people. Now, I don't think that you'll be surprised to hear, I don't think that invalidates what we've done. I think particularly it is interesting that those numbers on people not knowing what they're going to do are quite high, even before all the uncertainty that's come in over the last 3 years or so. It's a mug's game predicting things, but you can imagine reasons why that might rise over the course of the last 3 years with pandemic, with the cost of living crisis. In terms of the DC-DB change, these are kind of gradual generational changes. The decline in DB was quite, in terms of DB participation, was quite quick, but there's still a not trivial number of people who are still in DB schemes, active members of DB schemes now, largely because, roughly, well, over a sixth of the employees are working in the public sector. And so, there's lots of households which have at least one person working in the public sector, even before you have any remaining DB pension wealth. So yes, it will decline gradually. It's not going to completely drop off a cliff over the course of 3 years. I don't know actually if anyone, if Nigel and Nick want to come in on that.
I can offer a couple of comments, particularly on that last point. No, so I totally agree. We're not seeing any kind of like sudden change from the trends of 2018, 2020 to now. We think there's about 800,000 people in the private sector DB schemes still accruing, and obviously quite substantial rates of pension accrual, and then as Jonathan said, lots in the public sector as well. So I think that bit doesn't matter. What we could maybe do, and again I'm not quite sure how much IFS have done it with the existing data, is to really zone in on the bunch who've only got DC, and you perhaps you've done that, Heidi and Carl, I'm not sure, Jonathan, but I mean that could give us a little bit more of an insight as to what may come in the future. But there is a lot going on. I mean, it's like who would have expected the Spanish Inquisition? I mean, we didn't expect, Ukraine war, reversion to normal, traditional historical interest rates, and COVID, did we? So it is pretty hard to take account of all of those things. I think for me, out of those things, the two things that we'll really need to have a good look at. One is this business about annuities becoming popular again. That seems interesting. Maybe that helps address some of that confusion and uncertainty point. And then I think the other thing which is a bit less clear is the whole business about people dropping out of the employment market in the later 50s and 60s, and what's happening with the finishing post, the state pension age, getting further away. That's quite interesting as to whether people are going to be using their pensions, whether it become a social norm to use their pension as a bridge and just kind of wind down and work part-time. But again, that's still quite early days.
We're quite fortunate that we have the data from today and yesterday, and every morning I get reports on what we did yesterday, how many quotes we had, how many acceptances, etc. So we're very, very lucky that we're sort of the sharp end. But every single statistic is improved, is increased. So annuity quotes we're getting at 15,000 a day. Not long ago that was only 8,000 a day. Obviously those quotes don't turn into clients, etc. But there's a huge change in approaches, and advisors aren't requesting 2 quotes or 3 quotes, they're requesting 10 or 12 or 15 to try and get a bigger the scope right, and to understand, does a guarantee period work and how much does it cost, does value protection offer some bits and pieces. The index linking that you talked about, Carl, there is really of interest to people, but they're still not going for them. They still want those higher guaranteed incomes, and human nature is what it is, and you can understand that behaviour. We're also seeing the average fund size increase, and I think that's not due to amazing market returns, that's because of extra contributions. But it's a growing market. The one area I don't have information on is the cashing out of plans. That's a little bit worrying. Where you come from a perspective of the importance of that to that family and to that individual, which is brilliant. But the thing that really frustrates me is that people are paying extra tax on that DC pot to get it out, and then sticking it in a bank account, which is then being taxed again. I think that's an area that the industry needs to work on, because everyone's working on getting bigger pension pots, and then people are taking them out and losing some of it to the HMRC. Now that is, I think, more of a concern than the importance of the pot. It's just how it's used and how much of that pot actually gets used by that individual.
Nick, if you don't mind, perhaps a couple of follow-ups on that. I mean, do you have any sense at which it's just rising interest rates, rising annuity rates, which is increasing their popularity, or whether increased uncertainty and volatility and kind of more uncertain times, which is making people put more weight on the safe product rather than take the risk? And I guess the second one was more about clearly a huge issue that people drawing the entirety of their pension could be a bad decision for tax reasons. Essentially, you pay tax on the pension when you take it out, and you might want to spread that across more than one tax year to smooth your tax rate. To what extent does Pension Wise help with that, or is it more detailed financial advice that individuals are needing to manage that, do you think?
I'll take the second one first, if I may. Taking the pension in one lump sum obviously means you're going to pay tax at your marginal rate. So spreading it over 2, 3, 4 years is really easy. You can either do it with the existing provider, or you can buy things like fixed term contracts where you get the income spread over that period and it ceases. Now, do you need advice to do that? Yes, you probably need a professional to assist you. Now, whether that is a highly experienced IFA, or could you use an online broker? I think people can make that their own decision, but I think some form of additional guidance beyond Pension Wise is required for those type of transactions. In terms of our annuity rates, the driver to people's desire, I think it's got to be a considerable factor. Yes, security in difficult times is attractive, but you are effectively looking at the same product 9 months on that's 30, 40, 50% better. You know, if anything in life that moves that far becomes much more attractive to you, if the car's that much cheaper, or property's that much cheaper, or a pair of shoes is that much cheaper, you're more interested, to be fine. But I think we've had so many years of good returns and good markets, and now have 3 years of not a great deal. I think that's starting to change people's perceptions completely.
Nigel.
It's a combination.
Oh, I just wanted to add an extra thought triggered by listening to Nick there. Just when he talked about all that extra money has gone into DC, and it kind of made me think, oh yes, that would partly have been the transfers from DB to DC. And of course, those transfer quotes are going to be getting to be much lower now that discount rates are going. So that may be another change that we'll be seeing. So maybe less of that.
Yeah, quite right. I mean, I guess the other thing that will be changing at a fair pace will just simply be amongst new retirees, how many years since 2013 have there been? If you think that's the point at which people started to get automatically enrolled, and it made a very big difference to DC coverage, if you go forward 10 years, you'll be doubling essentially the amount of time that people have had in that post 2013 environment. For some, they will have been in a DC pension regardless, but for quite a few, they will have been brought in because of that. And they may not be massive pots, but they'll still be getting quite a bit bigger in percentage terms. I want to ask a bit about the 43%. Perhaps I'll start with Heidi and Jonathan. There's a bit of pushback. Perhaps it's not surprising. People aren't that engaged with their pensions. Are we really surprised that so many people don't know what they're going to do with their pot when they get to retirement? And I guess expanding on that a bit, I guess I'm a little bit torn in that maybe it doesn't matter if I don't know what I'm going to do with my pot, as long as I've got a good plan for how I'm going to find out when I get close to that point. And people don't need to know about annuities or drawdown until they get to that point. But then again, if you're trying to persuade people to put money into a pension and you want them to do it voluntarily, you kind of think they need to have a good idea of what the point is and what they're going to get out of it. And I would imagine that selling a pension is a bit harder if people have got no clue about what they can use it for. So I'm a little bit torn about whether this really matters or not, at least up until the point of accessing the pension, where clearly people do need to get a good plan. Heidi, Jonathan, thoughts on that?
Yeah, sure. I mean, I think exactly like you said, yes, there is an argument that if you're still quite far from retirement, that you have plenty of time to make plans for how to exactly access your pension pot. But if you're making decisions around, how much should I save in order to have, the standard of living in retirement that I want to have, it's very difficult to make that decision of how much to save if you don't know what you're going to get with the money that you already have, or with kind of the trajectory that you're on at the moment. So I think that's one argument for why people should be thinking about this a bit earlier. And I think there's a worry that people don't realize that their DC pot is not going to automatically convert into a stream of income. So that's another kind of worry. I did think that what we looked at, for example, whether there were any differences in these responses based on whether people have DB well. So you might think that someone who has a DB pension is, maybe they have less of a need for a plan in their early 50s because they know that they've, already some of their pension is going to be coming from this stream of DB income. But we actually found very little differences in the prevalence of responses between those who have a DB pension and those who don't. So that was, I thought, quite interesting, and it just showed that there's something else going on. It's not just that people who have all these other resources are the ones saying, "Oh, I don't know what I'm going to do with this little bit of DC that I have." So yeah, that's my observations.
Thanks, Hayden and Carl. I think my perspective on this is, I think that people's 50s is important because we have a system now where lots of people are default, do basically what the defaults are in accumulation. And they don't need to do, they're not forced to make any decisions, right? It's passive. They don't need to make any decisions about asset allocation. They don't need to necessarily make any decision on how much they contribute. That's defaulted. Maybe they should, but they're not forced to. So that's a very that whole system harnesses inertia, few decisions, and unsurprisingly low engagement. That's the accumulation side. Clearly, decumulation is like the opposite of that, right? People have no defaults. People have to make lots of decisions, potentially, if they don't annuitize decisions over a number of years. That's a kind of high, engagement period of your life. In terms of what are you doing financially with your retirement incomes. So somehow you need to have a transition of people from a low engagement, for a lot of people, low engagement during their working life, to a higher engagement point at which they are going to purchase some form of product or draw upon their pension in some way. Now, I think that therefore your 50s is probably quite important as a period of making that transition. It's also a period where I think people should be thinking quite carefully about how much money they are putting in. It's kind of their last chance to make really big differences to their retirement incomes. Previous work from my colleagues has at least argued that some of the life circumstances that change in people's 50s in terms of paying off mortgages, dependent children leaving home, potentially allow people to make higher contributions. So yes, we all know people don't engage with pensions, but I do think people need to transition towards a higher engagement part with pensions at this point of their life.
Carl, can I just chip in? So I would argue, as I did in my initial comments, that we shouldn't put so much of a burden on people. I think the regime should be making it more like default products, so simpler choices. So you're going from maybe low engagement to medium engagement, rather than having, so kind of like choosing a car rather than working out how to build the engine as well. So I think that's important. Another thought, just come back to what you were saying, Carl, on the point about, well, it'd be really good if people knew why they're putting money into this thing, what they're going to get out of it. And that feels like a call for pension dashboards. Let's make sure progress is made there so that there's more of a connection between the money going in and the lifestyle that you're going to get later on.
Nick, any thoughts about the reflections on the lack of knowledge, engagement, and whether that's something we should be worried about or perhaps not too worried about?
I think we always need to be worried and we always need to look for more. But I think there's so many things pushing in the same direction. I touched on pension-wise, that's really, really developed. And people are becoming more aware of the importance of their DC pension, quite simply as it becomes more significant to them. And they will have friends and colleagues that are retiring and making these complex decisions, some with and without assistance. So I think it's all happening. It's just we've got to keep our weight behind it.
Thank you. So all this talk of DB is there's a question about public sector versus private sector outcomes. I'm not sure if we split the analysis by whether somebody had worked in the public sector or private sector previously, if there were any differences there, and I guess I'm going to relate it to another of the questions, which is about people in couples kind of coordinating their decisions, making joint decisions, if there's any evidence about whether if one member of a couple says they don't know whether the other member of the couple's got it all sorted, they have a plan, or whether we've looked at any of the whether the correlates between individuals within a couple. Heidi, Jonathan, I don't know if that's.
And so we didn't do the sort of exact split by public and private sector. I think we were looking at just whether someone has DB wealth, and obviously if someone has large amounts of DB wealth, it's sort of more likely that they are in the public sector. In terms of the decisions that people make in couples, again, some of the analysis we did kind of both at the individual level and then looking at the household. So, are these, is it different if you have DB pension in the household? And the sort of patterns look pretty similar, actually. And if we're looking at the composition of household wealth, it also looks pretty similar to the composition of individual wealth. So we didn't see huge differences there, but I think it's a really, important thing. And I think something that, again, I'd be interested in hearing from the industry as well, and pension wise, to what extent when people get in touch with advisors or these pension wise guidance, for example, to what extent, are things like what pensions does your spouse have? What happens if your spouse passes away unexpectedly? To what extent do you rely on your spouse's pension in retirement? What's going to happen if, a lot of the money or wealth that you have available will go to your spouse's social care costs? And, there's a lot of considerations there. So it's an important thing to look at. And I think probably needs a bit more analysis for us to do as well.
I think two things for me. Clearly, people need to be taking into account the housing situation and what their partner has. But I think one of the kind of difficulties is, as I understand it, independent financial advisors will help you take these things into account. For people who don't have that, it's harder to, at least from my perspective, hard to see how you can make things, do any kind of default things or make it very easy to take into account those things. Even pensions dashboards, which when we get there, is in an individual level, right? And you don't have how much is left on your mortgage or how much your partner has in there, right? And that's not necessarily a criticism. It's a reflection of reality, but it makes it harder to kind of potentially think about these things by default. The only thing, the only extra little thing on this is that it's clear we do know in the accumulation side there is at least some coordination of some of these decisions within couples. About the only really strong predictor of people opting out of automatic enrollment that we found a couple of years ago is that your husband or wife or cohabiting partner opt out as well. There seems to be some form of coordination going on within couples about opting out of AE. Unsurprisingly, people to talk to their significant others.
Thank you. So we have a question from Alice Guy, who's at Interactive Investor, one of the members of our consortium, and she's asking whether there's more that providers can do to encourage people to engage more with their pensions and using that to help get to better outcomes. I want to wrap that question also into dashboard, I guess. I think that we've started talking about pensions dashboard. I think undoubtedly having that resource available would be a good thing. I guess I worry about to what extent will large numbers of people really engage with that at the appropriate frequency. And I guess we've also already, just from Jonathan, heard the plea, well, once we've got dashboard up and running, can we start to add other forms of wealth on there too? Other investment, savings, housing wealth. So the shopping list will undoubtedly grow. Nigel, Nick, I don't know, any reflections on kind of how important dashboard can be and also what more providers might be able to do in this space?
I'll just say a couple of quick words then on the sort of the industry efforts to engage the population. Some of you may have noticed that there was the first Pensions Attention campaign last September with Big Zoo, who is I'm going to get this wrong, is he a grime artist? I'm not sure. I only heard him talking about pensions or singing about them. I keep talking. So there's that, and there's another one of those planned, and that's a pan-industry thing, all bits of the industry, DB, DC, insurers, trust-based schemes, sometimes they're the same, this autumn. So they're trying to do stuff. As you know, PLSA, we've been doing retirement living standards for a few years, again, to try and build awareness of how much you need in retirement. It seems to get quite a lot of take up. Individuals find it very interesting. And I know a lot of providers have included it in their online tools, which they're increasingly providing to help bring all of this to life. So I think a lot's been done. I'm sure Nick will have extra things to say on that. I think on maybe Nick, sorry. I think on dashboards. Well, you know, so all the evidence of dashboards use in other countries is that they tend to be most popular with those not too far from retirement, which is pretty much the group of people that you've been targeting in this research. So the 50-plussers. So they do use them and they do engage them. It'll probably be harder to get perhaps Gen Xers in. I do wonder, though, given that, you know, younger folk are increasingly digitally engaged, and we've all got our banking apps, and obviously the dashboard's design is such that, you know, that there will be multiple providers. So when you're checking how much you've just spent on your coffee, and for me, that was £3.40 at Costa yesterday, which did shock me slightly. You know, you'll be able to say, oh, and here I am on my pension saving route. So, you know, I'm sort of quite optimistic, really, about engagement using digital and these tools going forward.
Well, we're keen to do more. The more we do, the more publicity, the more information, the better. I think from our perspective, we're focusing on improving our technology to try and make it work better for the members and clients in every level. The dashboard obviously been delayed, but I think that will make a tremendous difference, and that will just bring those numbers and the emphasis of all pensions to the fore. And Nigel's right, it's going to be those that are closer to accessing it that will show most interest. But I think when we get that, it'll be another step forward, and the digitalization of the whole of this process will make a huge difference. There's no doubt about it. And all the examples we've got, and banking apps, as Nigel said, parking apps, just make life so much easier. And you know, why can we do that for parking, but we can't do that for something like pensions that's so important?
Thank you, Nick. So as we approach the end of the allotted time, I thought I'd just do a run round if anyone wants to make any final thoughts, anyone wants to address any of the other outstanding questions on Slido. There's one, for example, on political stability around pensions policy, which might be the one that people might want to pick up on. Or alternatively, just kind of the key messages you've taken away from today. Start with Heidi, and then Jonathan, and then Nigel, then Nick.
Sure, yeah, so I didn't have a chance to look at the Slido. I might just add to what was just discussed around the pension dashboards. Actually, I think, while the pension dashboards are going to be hugely valuable in terms of giving people an idea of what they have available to them and all of that, it is going to be so important to get the sort of guidance around that right as well. Because what we don't want is people to be logging into their pension, every month and seeing that if you're thinking about the swings that you would have seen in your DC or DB pensions over the last couple of years, and how that might kind of rush you into making decisions that really aren't the right ones. There's also risks around this increased engagement, and when people have complete freedom to decide how to access their pension pot. So I would also just add that as we have pension dashboards, I think the guidance part is going to be even more important.
Yeah, I think my reflection is just thinking out in the future, not just the numbers of people with DC pensions, not just the size of those pensions, but the kind of types of people that are going to have larger DC pension pots. It's clear that, at the moment, those with really big ones, have probably had, maybe quite successful careers. The DC pensions haven't been around for that, lots of contributions haven't been necessarily around for that long in pensions terms. If we do look, for people currently in their 30s, early 40s, and as they, admittedly take quite a while to get towards retirement, you're going to have many more people in more typical jobs, maybe typical life circumstances, maybe not with quite such high levels of education as those with really big pots now. And so I think we need to think about that change in composition of the market, and make sure that kind of policies and ways that firms engage with them are appropriate.
Just a couple of points, Carl, on that political consensus point, or rather the political stability point. I mean, clearly we got an election Jan 25 at the very latest, much more likely in a year. Pensions is turning out to be a bit of a slow game in terms of achieving the vision of the Pensions Commission already 15, 20 years ago. I really think we in the sector and all the experts in the sector should try hard to help establish a consensus, so we send some nice simple messages and clear messages to the current government and to the future governments, whoever they'll be, so they can understand where there is a consensus and maybe what they should be doing. Because I think they often hear all these subtly different perspectives, all of which are 100% correct, and then they kind of end up doing nothing. I mean, to be fair, there is movement now. The current minister has made some movement on AE, and I know she's got lots of dynamic plans that we're seeing. But nevertheless, going forward, it'll be very important.
I haven't got a huge amount of comments other than to thank everyone for having us to participate. But the one thing I think will make an enormous difference is if and when the civil service, the police, the teachers, EC, that will be massive.
Thank you very much, everybody. So we've reached the end of our time. I found that incredibly interesting and enjoyable. I hope you all did too. Big thanks to Heidi and Jonathan for the report today. Big thanks to Nigel and Nick for joining us on the webinar. And I hope to see you all again at an IFS event sometime soon. Bye-bye.